So it looks like the numbers are out and the inflation numbers are nowhere near what they really are in reality. You and I both know, according to our living expenditures, everything is going through the roof. But according to the CPI, those numbers are still well below the target that the Federal Reserve is looking to actually achieve and then overshoot. But yet the problem is, if we use history as any type of guide, it tells us that extreme inflation always follows radical monetary policy. And today I'm going to share a chart that proves my point. Let's talk about this. So today I just wanted to connect for another RTD quick take, share my 2 cents on what's going on, and just expose how bogus this whole CPI number really is when you look at the fact that every day, everything we do is going up in price. And as of today, the stimulus package was officially passed, waiting to be signed to add more digits to the number of currency units that are already into existence, which at some point will rear their heads above the water and expose the fact that we are in for a hell of a ride when it comes to inflation and the overall cost of goods and services for our everyday lives. But before I dive into this quick take, I want to make sure to encourage you guys, if you're new to the channel, make sure you hit the thumbs up button to subscribe and show your support for the channel. And then also click the notification bell, and hopefully YouTube will notify you. But just in case they do not, I would encourage you to scroll down below and click the link, and you'll get notified by me directly whenever we go live during the evenings. And that's at rethinkingthedollar.com/live. And then, of course, these videos are geared towards making sure that I get some feedback from you guys, because I'm curious to hear what you think. And you can further add to the discussion by leaving comments down below. And lastly, the information shared is nothing that you're going to hear from the mainstream media sources. So it's up to you and I to continue to share as much information as we can. So I encourage you to share this video if you find it of value and really highlighting the severity of inflation moving forward. But here's the main graph I wanted to touch on today to give you an idea as to what's really going on. And this gives us a shorter view, as well as I'm going to zoom out and show you a longer time frame as to how, based upon the current response to this whole global pandemic situation here, we are in for an extreme amount of inflation, given the fact that radical monetary policy always results in higher inflation, and history is a good teacher of that. And I'm going to pinpoint that today from this graph right here. And so here you guys can see we have the M2 money supply versus inflation. So this information here comes from the Federal Reserve website, and along with that is the Robert Shiller online data that goes back towards the 1800s and 1913s, which is where I'm going to take this eventually. But as you guys can see here, what makes this unique is the fact that this black line here is the M2 growth rate. And of course, since the last monetary spike we had here, where the M2 money supply grew about 10.43%, ever since that time frame there primarily was a quantitative tightening side of things, until something broke in the fall of 2019 with the whole repo action. And then of course comes the COVID strike, which has led to what would be considered the most radical monetary response in modern history, and is just beginning with this increase of the M2 money supply, as it says here, to the tune of 25.58%. And along with this, the inflation, according to what we're being told here as of now, is about 1.7. And so this graph here, when it comes to inflation, goes back to December of last year, but yet once again is well beneath that 2% inflation mandate that the Federal Reserve have always shot to achieve. But yet, given the monetary changes, they're looking to overshoot that. This graph here, when you go back in the time, you get a chance to see what happens as a result of when the M2 money supply spikes, and what usually follows right thereafter happens to be inflation. But since the rules to the game was changed in the early 1980s with how they calculated CPI by removing gas and food, which are the core essentials for our everyday expenditures, this graph here will give us a good example as to what we can expect when something breaks in the system and the result of this extreme monetary policy is no longer able to be hidden. And so here I want to zoom out back to the beginning of this chart, which begins in 1870, which I think can give us some key insight as to what we possibly could expect down the line when the money velocity picks up as a result of this new round of stimulus, as well as a future stimulus that will come, actually gets out into the economy when people actually go out and start spending, as the whole narrative of a recovery continues to increase due to the jab that's going into the arm and how things are starting to recover. Once that all takes place and the M2 picks up, that's when I can see severe inflation as a result of this current radical monetary policy. So as you guys can see here, from 1870-ish up until a point where we get to about 1980 on this graph here, there was a large gyration of inflation as well as M2, to the point where it was extreme. And I'm going to go through each and every one of these blips up and down so you guys can actually see how I'm using this data here to anticipate what we could expect once something in the system finally breaks and an inflation rate shoot past what the Federal Reserve said they're aiming for. And so, of course, we know, if you guys follow John Williams and Shadow Stats, the 1980, the inflation calculation model changed severely. And of course, then, as you guys can see here in the red, it's been trending downward ever since they changed the rules of the game by how they calculate the rate of inflation. But if we were to go back prior to 1980, when the inflation numbers were more accurate and reflective of what it costs to live on a day-to-day basis, based upon what we actually spend for our goods and services, we get a much different story. And I want to take it back here because, of course, the Federal Reserve, what they're ultimately looking to do is to fight deflation. They're aiming to fight the contraction of the current monetary system because the boom and bust cycle has been distorted since the great financial crisis with the creation of all this quantitative easing and monetary tool policies that they've implemented to keep the system afloat. The whole goal in the monetary system, according to the way that it has been operating for the last 100 plus years, is to always keep the economy expanding at the rate, as they say, of 2%. And it's a reflection of how a healthy economy functions. But yet what's most interesting about this graph is the fact that all these red gyrations here, whether it be at the top or the bottom, they reflect the true corrections of a boom and bust cycle, where at the very top, as a result of monetary policy, inflation picks up severely, and then when there's a correction or a crash, i.e. a depression, it tanks severely. And so as you guys can see right here, we have some very severe corrections here in regards to deflation, which is ultimately a contraction of the economy, which in any other time is usually good for those that actually have true tangible assets in their possession. But in a debt-based monetary system, it's disastrous. And so one of the things I wanted to highlight in regards to something we're not really told is the fact that, according to the history books, the Great Depression of the 30s was the worst economic crisis we had in this country because it lasted for almost a decade. And the economy contracted severely, and there was a lot of chaos as a result of that. But according to this graph here, based upon the rate of inflation or deflation, the Great Depression was not the worst time in modern history. Because according to this graph right here, at the peak of the Depression, the inflation rate right here is at about a negative 10.67%. And in deflation terms, that's an extreme contraction in the economy. But yet, if you go back even further, we got things here that's even steeper. And the one I'm pointing at right now happens to be Black Tuesday, which took place in the early 1920s. And so this one was 14.92%, which is even more extreme than the Great Depression. And then if you go back here towards the 1890s, we had another severe depression, i.e. correction, negative 13.25. And then you go back even further. 1877 was probably the worst in regards to the contraction of the economy, i.e. a panic or depression, and it was 15.65%. All these severe contractions in the economy followed or were a result of extreme monetary policy. And so right here, we had extreme inflation before there was radical monetary policy. And of course, the M2 growth rate at this particular point here in 1880, it says was 20.14%. And so that is the second highest increase in the M2 money supply at any particular time up until this current point. And this followed a severe contraction of 15.65%. And then you move forward back to the other time frame. Here we have 13.15% M2 money growth, which followed the 1893 market correction. And then you fast forward to Black Tuesday, as I mentioned here, which was 14.92 at the very bottom. But the monetary policy that came before that, severe inflation of about 20.68%, happened to be a growth of M2 by 15.52%. And then, of course, we got World War II, where the money supply spiked by 16.78. And one of the things we're always told is that the greatest spike in the M2 was the World War II time frame, where according to this chart right here, it happened to be back in the 1880s, which is something they don't want to go back towards because that exposes how gold and silver was a part of that equation as well. So as you guys can see here, we got these sharp gyrations here. We got extreme deflation at the very bottom and extreme inflation at the top. And all of it was tied to the fact that the M2 supply was extremely high. It either followed inflation or it preceded inflation. Either way, whenever the monetary policy response was extremely favorable in the form of expanding the monetary base, inflation was not too far away, and extreme inflation to say the least. So just this chart here, we had 1, 2, 3, 4, possibly 5. If I was a betting man, I would still, based upon history, say that regardless of the fact of them changing the rules to the game by removing gas and energy and altering the metrics in which you calculate the true rate of inflation, when something in this current system breaks, it will be virtually impossible for this level of inflation right here of 1.7, they're telling us, to actually exceed the amount of monetary stimulus that's been brought into existence. And right now we are at historical levels with this 25.76. It's the highest it's been in history across the board. So what would make you think that the amount of inflation that has to come after this will not also be extremely severe, borderline, the door opener for hyperinflation? It will boil down to the velocity of the M2 money stock. And so as of right now, the currency units in existence are not circulating because people don't feel comfortable to spend because of job insecurity, jobs concerns, or it's just not time to go out shopping yet. But at the moment this velocity picks up, that will be the driver for that extreme inflation we should all be expecting. And as a result of that, the Federal Reserve will continue to do more of what they're doing now to try to keep this game going, which will ultimately lead to the destruction of this currency. So that's all she wrote. I just wanted to check in real quick, share my 2 cents as to why I believe extreme inflation is baked into the cake based upon history. So I just wanted to put this out there. What do you guys think? Is using history as a guide to predict future events something we should rely upon, or what? I'm curious to know what you think. Leave a comment down below. If you've enjoyed this, if you got some value out of this, hit that thumbs up button. And to take this information, share it with your family and friends so they can find out what's really going on. Talk to you later.